Hello, we're going to start with our presentation today. Sorry about that. We're going 1 minute. Okay, we'll try again. My name's Jennifer Hanna, and I am going to go over the accounting for mortgage servicing rights. It's a really large topic. I emailed a couple clients to see if they had any suggestions. So from their suggestions, I put together the webinar. Unfortunately, we couldn't hit every single suggestion that everyone had. Everyone had a lot of good ideas, but it's such a voluminous topic we couldn't hit everything. But anything that we don't cover, feel free to shoot us an email, or there's a question box within this webinar where you can type in your question, and at the end of the presentation we'll respond, or we'll shoot you an email to get additional information if we can't answer the question right away. All right. And I'll give you my email address and telephone number at the end of the presentation. Okay, let's start with our first slide, mortgage servicing rights. Oh, give us 1 second. We're going to go through mortgage servicer rights, and then Gregg, a senior audit manager on the team at the firm, is going to go through mortgage banking financial benchmarks for the year and kind of give you an idea of how different companies compare against each other without actually disclosing the company. Okay, let's get into the topic, mortgage servicing rights. If you have any interest in reading through the codification, which I imagine a lot of you have no interest whatsoever, I wanted to put that in the slide to make it easier in case you had a specific question or you wanted to go through the standard yourself. It's 860-50, and a lot of you probably know it used to be FAS 140 and FAS 156, and before FAS 122 was superseded into FAS 140 and 156, it used to be FAS 122. But all you need to know is codification 860-50 in case you want to go through it in more detail. The topics that we're going to try and cover are probably the first 3 topics. I wanted to give you typical valuation criteria because we had a lot of questions about that, but it's such an extensive subject we couldn't go into an extensive amount of detail. But if we have time, we'll definitely go over the key topics within that. So our first topic, the initial capitalization, is how do you initially capitalize those mortgage servicing rights retained, and also if you purchase a portfolio of mortgage servicing rights. After that, we're going to go through your 2 different types of mortgage servicing rights accounting methods and the related financial statement disclosures related to those methods. Okay. First thing is the initial capitalization. One thing to keep in mind, if you consider going into servicing, make sure you read through your debt covenants. Your debt covenants, some lenders, not all of them do this, some of them will haircut or disallow servicing assets. So keep that in mind when you're initially getting into this, to kind of pay attention to that for your debt service or your debt covenant calculations. Okay, let's start with the initial capitalization of mortgage servicing rights. All MSRs, regardless of what accounting method you use, are recorded at fair market value. This fair market value can either be a servicing asset or a servicing liability. What a servicing liability means is if the cost you incur to service that loan exceeds the actual fee that you're going to incur for servicing that loan. For example, if you have compensation expense and this loan is a dog and it costs a lot of money to service this loan and that exceeds the fee that you're getting for it, you actually have to record a liability, and you have to record that separately. Initially, during your capitalization phase, I highly doubt you're going to have a service liability, but over the loan's life, these things fluctuate in and out of a servicing asset and a servicing liability, and you're required to show those separately on your financial statements. Okay, and lastly, this last section on the PowerPoint, excess servicing rights. We're not going to go into too much detail into this, so if you have any questions, shoot me an email. But this is basically the rights to future interest income from serviced assets in excess of contractually specified service fees. And these are accounted for like interest-only strips, but they're not interest-only strips. but it's too much for this presentation. So again, if you have any questions on that, go ahead and shoot us an email or send it through the presentation. Again, just to kind of reiterate, all MSRs, regardless of what accounting method you use when you initially record them, you're going to record them at fair market value. Coming up with the fair market value, though, is not always a simple task. You know, there's not a liquid market for these mortgage servicing rights. Because there's not a liquid market, there's no quoted market price anyway. So you have to determine what the fair market value is yourself. We definitely have guidance. We have at Richey May access to a lot of different appraisals. So we generally have an idea of what range these values should fall into. But it's all based on valuations and, you know, different information that we've kind of gathered from various companies. Okay, so to determine the fair market value of the mortgage servicing rights, you're going to take the present value of your expected future cash flows from servicing the loan. So the money you expect to collect in the future, less your expenses, you're going to take, servicing that loan, you're going to take that net present value, and you're going to discount that by a discount rate that kind of correlates with the risk that you have in servicing these mortgage servicing rights. So it's not something that's completely straightforward, but we're going to go into how you come up with the fair market value in a little more detail on the next slide. Like I mentioned, so that's if you have mortgage servicing rights retained. Now let's say you go out and you purchase a mortgaging servicing rights portfolio. You purchase this entire portfolio. You don't need to calculate the fair market value on this. What you purchase this portfolio for, the cost of this portfolio, that's automatically going to be your fair market value. Even if you purchase this at 30 basis points less than what you think the value of the purchased MSR is, you're still going to record that at the purchase price. And I wanted to put this in here too. I'm sorry, can we go back a slide? At the bottom of the slide, when it comes up again, we put the MSR Evaluation Ranges that we saw during our 2011 audit, the low end versus the high end. This is typically what we saw for 12/31/2011 audit. This is basically your servicing asset in correlation to your unpaid principal balance. So if you're thinking of getting into this, this is something to maybe look at for your various portfolios. Okay, so just to go into a little bit more detail on what makes up these fair market values. Just some of the factors that go into this fair value calculation. The estimated life of the loan, because you're servicing this loan, so obviously you're going to generate income over the life of the loan. Just keep in mind that this life of the loan is completely independent of the loan term. Your loan term may be 30 years, but how many of us know a borrower that has kept their loan for 30 years? It doesn't happen so much these days. So you really have to take into account, and this is really key in the fair market value calculation, is that prepayment speed. And this prepayment speed, it's influenced by a ton of stuff, heavily by your borrower's geographic location. If they're in Arizona or Mississippi or other slightly more depressed areas, the prepayment speed is definitely a lot faster. Also, the earning status of the borrower, that also has a significant impact on prepayment speed, default rates, that sort of thing. So that's just the initial part of the fair market value calculation. You're also going to have to consider the discount rate, the servicing type and age of the portfolio, the default rate, which can also be, as I mentioned, heavily influenced by geographic location and earnings. These are some of the things that go into the fair market value calculation, but there are definitely a lot of other factors that go into this. So we would highly suggest using a third-party evaluator, especially if you are initially getting into it and you don't have a massive portfolio to kind of support the cost of doing the valuation yourself. Okay, so let's get into our journal entry. You received your valuation and you have a loan with an estimated fair market value of $100,000 and a 1% MSR. Our entry would be, obviously we have to record the loan, so we're going to hit our cash, we're going to hit loan, and we're going to hit our servicing asset for 1% of our loan value, or $1,000, and we're going to hit the entire servicing asset, the gain, and run that through your P&L for gain on sale for your servicing rights retained for $1,000. And I know it seems strange to recognize the entire servicing asset balance and income in the current year, but keep in mind this income is going to be offset by your future amortization expense that you're going to take on this servicing asset. Also, one positive thing to think about, this servicing asset, the gain portion that you pick up in that beginning year, you're not going to have to pay tax on that. That's not taxable income. So that's one benefit of it. Okay, now that we know how to initially capitalize the mortgage servicing asset, we're going to go into the two types of accounting methods you can choose once you capitalize your assets. First one is the amortization method, which around here we call it lower of amortized cost or market, and this is what the majority of our clients typically use, amortized cost. Second is the fair value method. And I want to go into the benefits and drawbacks of both methods to help you kind of decide what method best fits you. Under the amortization method, it's definitely less volatile, so you're going to have more stable income and loss. Because you have that asset value, you're adjusting it only downwards to your fair market value if you have an impairment loss, and you're depreciating it. So it's definitely a more stable income stream that you're going to have. So your balance sheet, as a result of that, is more conservative. But unfortunately, there is more of an administrative burden related to this amortization method, so you have to keep that in mind too. On the flip side, obviously, the fair value method, it's more volatile. You're not amortizing that asset, so you don't have that cushion. So if you have some year where it's great and the next year the loan, it's not worth anything, you're definitely going to have higher spikes in your income and loss. The positives on it, your balance sheet more closely reflects the economic value of the mortgage servicing right, and it's always going to be greater or equal than the amortized method value. It's also less administratively cumbersome. It's actually really easy to track and take care of. But I think what this encourages a lot of people is that fluctuation in your income and loss. One other thing to consider, the fair value method, you cannot go back to the amortization method. If you're in the amortization method and you decide, hey, I want to go on the fair value method, you can actually do an accounting policy change if it's done in the beginning of the year. But if you select the fair value method, you can never go back to the amortization method. So that's also something to consider. All right, so let's go through the similarities between the assets. First, when you have your bundle of assets and you start to put them together, you're going to have to stratify them into different classes. These asset stratifications are typically based on things like financial asset type, size of loan, interest rate, the date of loan origination, the term of the loan, and geographic location of the loan. Once these assets are stratified, and an accounting method is chosen, you have to apply the same methodology. If you stratify your loans into different classes and you take on new loans that fit into these class categories, you can't suddenly change accounting methods. You're kind of stuck with your established classes. But under both methods, you need to determine the fair value at least once a year. And for us, we would highly recommend doing this at your year-end for financial reporting purposes. For the fair market value, obviously you need the fair value to know what to adjust your servicing asset up or down to. And for the amortization method, you need to know if you have an impairment on your servicing asset. So that, I think, trips people up a little bit. You are still doing amortized cost on your amortization method, but you still need to know the fair value to assess impairment. And also keep in mind that initial capitalization, under both methods, you're going to do the fair value. And I think in the beginning, sometimes that confuses people a little bit. Okay. Now let's go into the specific methods. Our first, more popular method, the amortization method, or lower cost of market. The amortization method, what you're going to do is you're going to amortize your servicing asset in proportion to the estimated net servicing income. And what that means is that asset that you record, your servicing asset, it's an asset that directly correlates to the servicing of a loan. That loan typically is prepaid. It's typically not over 30 years. If you have a bundle of loans and you go through the process, your income that you generate from servicing those loans, it's not going to be on a straight line basis because of prepayments, default rates, all of that. So you kind of have to do your best to assess what your net income stream from your portfolio of loans is going to be, to determine how you should be amortizing them. Typically, we see loan servicing asset life ranging from 4 to 8 years, depending on the estimated life of the loan. And again, that's totally different from the term of the loan. Also, under the amortization method, you need to assess the servicing asset for impairment, as I kind of mentioned before. In order to assess the servicing asset for impairment, you need to determine the fair market value of the servicing asset and to see if your net book value is higher than what the fair value is. If it's higher, then you have an impairment, and you need to record that. But we'll go into how to record that in a little bit. So again, this is really important. Keep in mind you cannot simply amortize the servicing asset on a straight line basis. You have to estimate the future net servicing income and correlate that to your amortization expense. And typically that's higher in the beginning years because of prepayment speeds. People tend to, we have that 4 to 8 threshold where people, from what we've seen, refinance, prepay, and sometimes default on their loan. So the AJE is very basic. You hit your amortization expense, you hit your accumulated amortization, and then in a separate entry, and you can combine them, but just it's a separate transaction, you're going to record that servicing income that you receive from that loan and the related servicing expense, and obviously you're going to have cash. On a tax note, the amortization, because we didn't take, when we initially capitalized that loan and took the gain, recorded that gain on the servicing asset, we did not pick up taxable income. So unfortunately, the correlated amortization expense for that servicing asset is not taxable income. But the servicing income and servicing expense, the actual cash that you get for servicing this loan, that net number is taxable income. Okay, so let's go into a little bit of detail on the impairment. We determine the fair market value, and the fair market value is less than our net book value we have recorded. So we have to record an impairment loss. To do this, to record this impairment loss, we highly recommend recording the impairment loss and a contra asset account to the net servicing asset. The reason being is in the future, if the fair value of a previously impaired asset is greater than the net book value, you can reduce this allowance balance up to the previous impairment loss taken. And I know that's a mouthful. We're going to go through a journal entry or an example to kind of show what I'm talking about in the next slide. Just keep in mind, even though you have this contra asset account with previous impairment taken to reduce your servicing asset, you cannot apply an increase in the fair value of loan A to an impairment allowance recorded in loan B. You have to keep them completely separate. Also, on a side note, impairment loss is not a tax deduction for tax purposes. All right, so in year one, we have a net book value of $50,000. We have a fair value of our servicing asset of $40,000. So we're going to debit our impairment, and we're going to credit servicing asset allowance contra account for $10,000. And so that's pretty straightforward. Our first entry, we broke out our servicing asset allowance contra account. And our second year, we're going to book, or we have a servicing asset of $35,000. We have a fair value of $50,000, and then we have that previous servicing contra account allowance for $10,000. So in year two, what we can do is we can debit that contra account, assuming that year one, this was all on loan one. Year two, this was all on loan two, or stratification class 1 or 2. It has to be to a specific loan. So we can reduce that allowance account by $10,000. Even though our fair value is $50, we can't record $15. We can only offset it against the previous allowance amount taken. So definitely keep a contra account and keep track of what impairment you apply to what loan. Okay, And that's it for our impairment example. Now, our fair value method is really very simple. At your year end, you're going to get your valuations, and you're going to adjust your servicing asset to fair value and run the adjustment through earnings. It really is as simple as that. Again, just to reiterate, this method is definitely more volatile than the amortization method, and you cannot switch back to the amortization method. One other thing to consider, if you plan on hedging your mortgage servicing rights portfolio, it is definitely more beneficial to use the fair value method. But again, I don't think we have any clients. We may have a handful that hedge their mortgage servicing portfolio, so the majority of them use that amortization method. In this entry, we're going to record a write-up. You increase your servicing asset, so that means your fair market value is higher than it was, or higher than the amount of servicing asset you have recorded. You're going to hit income, and your fair market value is less. You have a write-down, so you're going to decrease your servicing income and hit servicing asset. And that's pretty much it for the fair market value journal entries. Okay, so the following financial statement disclosures. There are quite a lot related to mortgage servicing rights. I broke it up into amortization expense, or amortization method and the fair market value method, but the disclosures are actually quite similar. The following are required: your basis for determining the classes of servicing assets and servicing liabilities, or how you came up with your stratifications or asset classes from earlier, a description of the risks inherent in servicing assets and servicing liabilities, and also any hedge-related disclosure you have, anything to mitigate the risk of your fluctuations in your mortgage servicing rights. You also have to disclose all of that information. Another key thing is the amount of contractually specified service fees, late fees, ancillary fees. You have to disclose those and report where they're recorded in the statement of income. And that is it for step 5. So financial statement disclosures under the amortization method. You're going to disclose your beginning and ending service assets, any additions you have, purchases, transfers, any disposals of assets you have for possibly default, prepayments, anything like that, your actual amortization expense, and your valuation allowance, which again is mostly, I imagine, going to be your impairment loss, so you can kind of keep track of that separately. If you have other temporary impairment, any other changes also that affect that balance, you're going to disclose that in there. And this is key: a description of your valuation techniques used to estimate the fair value, and the fair value at the beginning and the end of the period. Even though you're using the amortization method, we still need to disclose how we're coming up with our fair value to estimate impairment. Also, this is a little redundant from the last slide, but the risk characteristics of the loan used to stratify the classes of servicing assets for the purpose of measuring impairment. For the fair value disclosures, it's very, very similar to the amortization method. Obviously, your beginning and ending service asset balance, any additions, disposals. Instead of having that contra valuation allowance and amortization expense, you're just going to record your changes in the fair value. Any other changes, and another key feature is a description of the valuation techniques used to estimate the fair value. Okay. And we had a lot of questions on the valuation and how you could better keep track of your mortgage servicing rights and determining what the fair value was. There's actually a ton of things that go into these valuations, so we couldn't kind of hit every single point, but just to give you an idea of what goes into these valuations. As we mentioned earlier, mortgage servicing markets, they're not liquid, so you have to take your present value of your future expected servicing income at a discount rate and kind of determine what the fair value should be. But key characteristics of a valuation portfolio are obviously loan count, your unpaid principal balance, your average loan balance, coupon rate, net servicing fee, the average age of the loan. And then we mentioned this earlier too, the servicing values are driven to a large extent by the buyer's expectation of prepayment speeds, voluntary and involuntary, where your borrower lives, their, economic capability, discount rate, float earnings, additional per loan income, servicing costs. There's a bunch of stuff that go into these loans. We would highly suggest, again, using a third-party evaluator like Mountain View or MIAC. We see a ton of valuations from them, and I'm sure there's a bunch of other really great evaluators out there that can help you out with this. But basically, when they go through these valuation processes, what they do is what we mentioned earlier. They're going to stratify the various loans into different classes or groups or homogeneous subjects. From these, they're going to project the characteristics of these various classes and stratifications. They're going to convert the characteristics into a flow of income and expense stream. They're going to adjust these for any prepayment speeds, any default rates, anything like that. And then they're going to present value these adjusted streams and then add up all your various streams from your different classes and come up with a value for you. Stratification, again, it's service type, loan type, original term. There's a bunch of things that definitely go into the valuation methodology. And I think that's it for the mortgage servicing rights. I think we are ready for if you guys have any questions. No?
All right. Thanks, Jennifer. Well, that was great, Jennifer. Thanks again. Mortgage servicing rights obviously is an emerging area, and it's a complicated subject. So I know she went through it, in pretty good detail, I think. So, but keep in mind, we will be providing these slides to all of our participants, and they'll also be posted to our website in approximately 2 weeks. So, and if anybody has any questions, my email will be at the end of this slide set, so you can send your emails to me and Jennifer, and we can clarify any questions you may have. So again, welcome to all the participants to our webinar. It's my pleasure to share with you some of the benchmarking data compiled from approximately 60 of our clients for the year ended 12/31/2011. The presentation will include an overview of the balance sheet and income statement, along with a review of certain ratios, followed by any questions. The most common question I get is, where's this guy from and what kind of accent does he have? So some of you I've known and I've met before, and just to answer that question now, I'm from Arkansas, so that's why I'm often accused of sounding like Bill Clinton. So anyway, a few highlights or maybe possibly lowlights for the year that we noted include loan production and net income decrease from the prior year. More companies are looking into retaining servicing rights, and interest margins are essentially zero. A few key ratios we calculated from the financial data include the current ratio, which is current assets over current liabilities, and liquid assets as a percentage of equity, both of which declined from 2010. This is primarily due to companies having less cash as compared to the prior year, and we'll look at the balance sheet here in a couple minutes. The leverage ratio, which is total liabilities over equity, increased to approximately 7% or exactly 6.9%. The leverage ratios have increased over the last few years, which is generally due to companies having higher warehouse balances. The equity ratios decreased from 2010, with the return on capital decrease corresponding with a 21% decrease in net income that you can see there about midway down the slide. Overall loan production declined 6% from 2010. Retail production declined 3%. Wholesale production declined 53%, while direct-to-consumer production remained, relatively steady with less than a 1% decrease. Net income in total dollars declined 21% from 2010, with a corresponding decrease of 7 basis points. And the pre-tax margins decreased from 48 basis points to 42 basis points. Overall loan revenue increased approximately 34 basis points from the prior year, which is primarily due to higher secondary marketing gains and also servicing revenue. which obviously is a point of emphasis since that's the topic that we just covered. And the more people I talk to, the questions that they have generally relate to, we're interested in getting into servicing. Can you help us with that? And then also compliance questions, that kind of thing. Interest margins were essentially zero. This is primarily due to a decline in the average conventional 30-year rate, as I'm sure you're all aware, and also interest rate floors by the warehouse lenders. And actually, there's some of our entities that actually had negative spreads. Now we'll cover some specific line items on the income statement. Gain on sale and loan fees increased slightly from 2010 due to higher secondary market gains. Servicing revenue increased as more companies are looking into retaining servicing. One thing I like to point out is, as you can see over in the 2009 column, there's zero for servicing revenue, also marketing expense, provision for loan loss and servicing fees. We started breaking those out in 2010, so we can start tracking those separately and being a little bit more specific relative to that. But you can clearly see that servicing revenue increased in 2011 to $1.1 million as compared to $576,000 in 2010. Again, sounding somewhat redundant, but interest margins were essentially zero, as you can see in 2011. It was the income was $2.1 million and the expense was $2.1 million. And you can kind of look back, and it was about the same in 2010, and maybe the interest margins were higher in 2009. As many of you may have noted in your own company, compensation costs have increased. We noted an increase of 9.5% or 29.6 basis points, which is a major factor in the decrease in net income. Also, the provision for loan loss decreased, which is most likely due to clients taking a hit during 2010 for indemnifications related to legacy loans. So you can see that provision for loan losses about $871,000 in 2011, and it was more close to $1.35 million in 2010. So I think a lot of people elected to take the hit during 2010. Next, we'll look at a snapshot of the income statement. Actually, let's just go ahead and look at the statement of operations by operating model, and then we'll look at a snapshot of the income statement. So basically, we're taking a look at it and looking at it by the retail, wholesale, and direct-to-consumer model. The retail model's net loan revenues were 338 basis points, and direct was 254 basis points versus the weighted average of 320 basis points, which is over on the right-hand side. When you exclude other income from wholesale, you can see in wholesale miscellaneous other income about $4.5 million. That's somewhat of an anomaly for the current year, but when you exclude other income from wholesale, retail actually had the highest gross revenue margins on the second highest production levels. Down at the bottom is the production levels. You had for retail, it was $946 million, wholesale $307 million, and direct-to-consumer, by far the largest, at about $1.5 billion. As is typical, retail paid out the highest commission percentage, which was 0.78% of production and higher than the weighted average. Wholesale had the highest net income margins of the group on the lowest production volume of $307 million. Direct-to-consumer had solid margins of 254 basis points, which was 66 basis points below the weighted average. Also, as is expected, direct-to-consumer had the highest marketing cost and the highest production at $1.56 billion for the year. Now we'll take a look at a snapshot of the income statement. Gain on sale of mortgage loans and other fees, net of direct costs, represent 97% of total revenue. And direct costs typically range between 10 to 15% of total loan revenues. Servicing and other income total 4% of total revenues, with servicing revenue being approximately 3%. As expected, the single biggest line item on a mortgage company's income statement is compensation costs, salaries, commissions, taxes, and benefits, which approximated 71% of total expenses. G&A and marketing costs totaled 14% of expenses. Occupancy and equipment costs were 8%, and provision for loan losses was approximately 3% of total expenses, and other individual expenses were less than 3% individually. Next, we'll review a couple of graphs that chart the margins and productions by model. All operating models recognized increases in loan margins from the prior year, with direct-to-consumer having the most modest increase of about approximately 1%. Wholesale recognized the largest increase in loan margins. So take a look and keep in mind, I'll leave this up here for just a second, the wholesale, which is the red line, and you can see the significant increase from 2010 to 2011. And then take a look at that, and then we'll move on to the next slide, which was its production volume by year and operating model. What's interesting about this graph is that the wholesale production had the greatest decrease. Noted on the prior slide had the largest margin increase, which I found that's somewhat interesting. Due to consumer production, direct to consumer production, having an increase of 3%. Now we'll review the balance sheet. Companies had slightly less liquid assets in the current year after 2010 and 2009. One thing again, 2009, we did not break out cash, so it was included in that cash balance, and we started breaking out the loan indemnification reserve in 2010 as well. We have noted a steady increase in mortgage servicing rights as companies are choosing to retain some level of servicing rights, and we expect this trend to continue in 2012. So as you can see, for 2011, mortgage servicing rights was, approximately $2 million, up a little bit from the prior year, and again, we didn't break it out in 2009. 50 of 59 companies surveyed were involved in hedging activities in 2011, and most had a net derivative asset at 12/31/2011. Lastly, equity increased in total dollars, but decreased as a percentage of total assets. So you can see near the bottom there, equity was 12.66% in 2011 versus 14.95 2010 and 16.79 in 2009. Now we'll cover the balance sheet by operating model. Overall, the retail model tended to correspond with the weighted average model. So as you can see, total current assets was approximately 96% of retail, and the weighted average was 95.3%. Retail and direct-to-consumer had the highest level of mortgage servicing rights. And the wholesale model had the highest equity percentage at 34%. Direct-to-consumer had the highest overall equity of the three models at $19.9 million, so you can see down at the bottom there. Next, the next slide provides a snapshot of the balance sheet. It looks kind of as you would expect, right? The loans held for sale are your largest asset, and your largest liability is the corresponding warehouse debt, with loans held for sale accounting for 87% of all assets, and the mortgage debt or warehouse lines of credit was approximately 80% of your total liabilities and equity. On average, companies maintained 5 to 6% of their balance sheet in liquid cash and marketable securities, and another 1%, on average in liquid cash, with an additional 1% in restricted cash. And restricted cash is primarily due to cash that warehouse lenders require you to pledge. Lastly, derivatives, fixed assets, mortgage servicing rights, and other assets average between 1 to 2% of total assets. Warehouse lines of credit average 91% of the mortgage loans held for sale, which is down slightly from the prior year, which it was about 94%. Companies have minimal other short-term debt and long-term liabilities, which represent about 3% of the total, and that it's a lot of things. It's mainly sub-debt, if you have some equipment financing through lease agreements, and then reserves. Accounts payable and other accrued expenses represent approximately 4% of total expenses. And on average, companies maintained about $12 million of equity capital with an average ratio of 13%. So that's an overview of our benchmarking survey. Hopefully you found that helpful. I tried not to go into excruciating detail. We can take some time for some questions, put the slides back up if anybody has any specific questions. But again, all the slides will be provided to everyone via email that participated, and we'll also have them posted to our website, at the end. And if you have any questions, here's the address and my phone number. Feel free to give me a call at any time. So now we'll see if we have questions. I must have covered this pretty good because we don't have any questions. But again, I know it's a lot of information to cover, both relative to the mortgage servicing, accounting for mortgage servicing rights, and then the benchmarking overview. But please take a look at the slides. If you have any questions, let me know via email or give me a call, and we would be happy to help accommodate you. So again, thank you for participating in our webinar series. And if you have any suggestions for future webinar topics, please, forward those to me. We have a few ideas, but we want to have these, on a regular basis, but we want them to be topical. So if, you guys out there are dealing with something that, you want us to address, let us know, and we'll accommodate that. So again, thank you for your time, and I guess that's about it.